The screens still glow green. Stock portfolios climb. Real estate prices hover near record highs. Retirement accounts pulse upward with artificial confidence. Somewhere in a quiet suburban kitchen, a man refreshes an investing app while coffee drips slowly in the background. Numbers move, charts rise. Everything appears normal. But history has a strange habit of looking stable seconds before transformation begins. Because the most dangerous collapses in human history never began with panic. They began with reassurance. Rome looked eternal before its currency rotted from within. Britain still controlled oceans while the pound quietly lost its throne. In Weimar Germany, people still went to cafes and concerts while their money evaporated in slow motion. Civilizations rarely feel collapse while they are living through it. The process is too gradual, too psychological, too normalized, and that may be the most disturbing part. Most people imagine monetary collapse as a dramatic event, a single catastrophic moment. Sirens, chaos, markets imploding overnight. But real financial resets behave differently. They move like termites inside the walls of a house, silent, invisible, patient. By the time the structure visibly bends, the damage has already been done. Today, the global economy rests on something stranger than gold, oil, or military power. It rests on collective belief. The modern financial system is essentially a giant theater production where confidence itself became currency. And confidence is fragile. That fragility hides inside ordinary life. A pension fund that depends on rising markets forever. A mortgage, inflated by decades of cheap money. A savings account slowly losing purchasing power while appearing stable. Millions of people believe they own wealth, when in reality they own claims inside a monetary structure that requires permanent expansion just to survive. That is the paradox no one wants to confront. The assets people consider safest may be the most vulnerable if the rules change. Stability becomes the trap. Because throughout history, reserve currencies never lasted forever. Not the Roman denarius, not the Spanish silver standard, not the British pound. Every dominant monetary system eventually reached the same invisible wall. Became easier than productivity. Printing became easier than sacrifice. Illusion became easier than truth. And now, the United States sits at the center of the largest debt-based system humanity has ever created. Governments accumulate obligations they mathematically cannot repay. Central banks inject liquidity to preserve markets addicted to cheap money. Entire industries survive only because interest rates remained artificially low for too long. The skyscraper still shines beautifully at night. But beneath the surface, the foundation is beginning to fracture. And somewhere behind closed doors, the smartest institutions in the world already behave differently than the public. Central banks buy gold while ordinary citizens buy speculative tech stocks. Billionaires quietly accumulate farmland, commodities, and hard assets while media headlines insist inflation is temporary. Nations once loyal to the dollar system slowly explore alternatives, not loudly, quietly, carefully, like passengers sensing turbulence before the pilot speaks. Because deep beneath politics, headlines, and daily market noise, something larger may already be shifting. A dollar reset, not a conspiracy, not a Hollywood apocalypse, a historical pattern. Every reserve currency eventually reaches a moment where trust becomes more important than productivity itself. And once trust begins to weaken, reality changes rapidly. Entire categories of wealth suddenly reveal themselves as illusions dependent on conditions that no longer exist. That is why this conversation is not merely about economics, it is about perception. Because most people measure wealth using a unit that itself may be deteriorating. Imagine measuring distance with a ruler that shrinks every year. At first, nothing feels wrong. The numbers still appear stable. But slowly, invisibly, reality changes while measurement hides the transformation. Modern finance operates exactly like that. The frightening truth is not that the dollar could weaken. The frightening truth is how deeply modern life depends on the assumption that it never will. Retirement systems depend on perpetual growth. Governments depend on perpetual borrowing. Consumers depend on perpetual credit. Markets depend on perpetual confidence. The system survives because everyone assumes everyone else still believes. But history suggests something uncomfortable. belief eventually bends, and when it does, wealth is not redistributed equally. Some assets survive monetary transitions, others vanish quietly into history, not because they were stolen, but because they were never truly stores of value to begin with. That is the real mystery hiding beneath modern prosperity. What if the next decade is not simply another recession? What if it is a restructuring of value itself? And if that is true, then the question becomes impossible to ignore. Which assets are actually protecting people, and which ones are silently positioning them for collapse? Because when currencies reset, entire categories of wealth disappear overnight, not because they were taken, because they were illusions all along. Long before digital banking, hedge funds, and trillion-dollar stimulus packages, empires discovered a dangerous secret. You can weaken a currency gradually enough that people barely notice. Ancient Rome mastered this technique. In the early days of the empire, Roman silver coins carried genuine value. Their weight inspired trust across continents. Soldiers accepted them. Merchants relied on them. Entire economies synchronized around their stability. But as Rome expanded, maintaining the empire became increasingly expensive. Wars multiplied, bureaucracies grew heavier. Political leaders faced a brutal choice: reduce spending or dilute. The currency itself, they chose dilution over decades. Roman emperors quietly reduced the silver content inside coins while preserving the same appearance. Citizens still held money, but the value hidden inside that money slowly evaporated. Prices rose, trust weakened, social tension intensified. Yet ordinary people adapted gradually because the process felt normal enough to tolerate that. Is the paradox history repeats relentlessly. Societies collapse psychologically before they collapse financially. The same pattern emerged centuries later when Spain flooded Europe with silver from the Americas. At first, unimaginable wealth poured into the empire. But abundance created distortion. Prices surged across Europe. Easy money weakened productive discipline. The illusion of prosperity concealed structural decay underneath. Then came Weimar Germany. The imagery still feels surreal today. Citizens carrying wheelbarrows full of cash just to buy bread. Children stacking worthless banknotes like toys. Middle class? Savings annihilated in silence while governments desperately printed more currency to stabilize a collapsing system. But even there, the breakdown did not begin dramatically. Inflation normalized itself step by step. Prices climbed gradually. Before accelerating violently, people adapted until adaptation became impossible. And then came Britain. For more than a century, the British pound ruled global finance. It financed trade, powered empires, and anchored international trust. London stood at the center of world commerce, much like New York does today. Then 2 world wars changed everything. Debt exploded. Economic dominance weakened. The pound slowly surrendered reserve status to the United States dollar. What mattered was not merely military power. It was confidence. Reserve currencies survive because the world collectively believes they will remain stable tomorrow. Once that confidence weakens, transitions begin quietly, then accelerate unexpectedly. Which brings us to 1971. A date most people barely remember. Yet it may have transformed the modern world more than almost any event of the 20th century until that moment. The dollar remained partially anchored to gold under the Bretton Woods system. Foreign governments could theoretically exchange dollars for physical gold reserves, but as spending surged and deficits expanded, the United States faced a growing problem. There were far more dollars circulating globally than gold available to back them. So President Richard Nixon made a decision that changed monetary history forever. The dollar would no longer be tied to gold in a single moment. Money became almost entirely psychological. Human civilization entered an era where currency could be created infinitely. But trust could not dot at first. The transition felt liberating. Markets expanded, credit exploded, consumption accelerated. Debt-fueled growth became the engine of prosperity. But beneath the surface, something fundamental had changed. The global economy no longer rested on hard constraints. It rested on confidence and perpetual expansion, and systems built on perpetual expansion eventually encounter limits. That is why history feels so unsettling right now. The United States increasingly resembles late-stage monetary empires more than modern societies are comfortable admitting. Debt grows faster than productivity. Asset prices rise faster than wages. Governments respond to instability with more liquidity instead of structural reform. The financial system survives by continuously injecting larger amounts of stimulus into an economy already dependent on artificial support, yet most people barely notice. Because normalization disguises decline, inflation becomes ordinary. Debt becomes ordinary. Fragility becomes ordinary. That is how historical transitions hide in plain sight. The frightening part is not collapse itself. It is the way societies psychologically absorb warning signs until instability begins feeling natural. Rome believed its system was permanent. Britain believed its dominance was permanent. Every reserve currency empire believed history no longer applied to them until suddenly it did. And if every monetary empire eventually reaches a breaking point, what exactly breaks first? Modern finance looks complicated on the surface. Trading algorithms flash across skyscraper screens. Central bankers speak in coded language. Markets move trillions of dollars in milliseconds. But beneath all the complexity, the modern financial system rests on something surprisingly fragile. Cheap money for nearly 2 decades. The global economy has functioned like a massive organism surviving on artificial oxygen. Interest rates stayed historically low. Debt became extraordinarily cheap. Governments borrowed, corporations borrowed, consumers borrowed. Entire industries expanded under the assumption that easy money would last forever. And for a while, it worked. Real estate prices surged. Stock markets exploded upward. Venture capital flooded speculative technologies. Luxury spending accelerated. Asset owners felt richer than ever before. But hidden beneath the prosperity was a dangerous illusion. Most modern wealth was not being created through productivity alone. It was being inflated through liquidity. That distinction changes everything. Imagine a city where every building appears taller each year. People celebrate the growth. Investors become euphoric. Politicians call it prosperity. But what no one notices is that the ground beneath the city is slowly sinking at the same time. That is what monetary inflation often feels like. Assets rise in nominal value, while the currency measuring them quietly weakens underneath. People mistake price appreciation for genuine wealth creation. But when the monetary environment changes, reality suddenly reasserts itself. And that is where the danger begins. Because many of the assets people trust most today are not true stores of value. They are leveraged bets on the continuation of the current system. Take real estate. For decades, rising property prices created the illusion that housing was almost invincible. Entire generations were taught that home ownership guaranteed financial security. But modern housing markets became deeply dependent on ultra-low interest rates. Cheap mortgages allowed buyers to borrow enormous amounts of money, pushing prices far beyond what incomes alone could support. The paradox is disturbing. Homes did not necessarily become more valuable. Money simply became cheaper to borrow. And when borrowing costs rise, the illusion begins cracking. Suddenly, monthly payments explode. Demand weakens. Liquidity disappears. Properties once treated like unstoppable wealth machines become illiquid burdens. The same asset that made people feel secure during expansion becomes fragile. European banks trembled. Asian markets crashed. Global trade slowed. Entire governments faced insolvency because American debt instruments, sitting inside international financial institutions, suddenly became toxic. One crack in the system sent shockwaves through civilization-level infrastructure. And that was before global debt reached today's levels. Now the interconnectedness is even deeper. Governments carry record obligations. Corporations depend heavily on refinancing. Consumers across the world survive on credit expansion. Entire economies require constant liquidity injections to maintain growth. The machine has become larger, faster, more efficient, and far less resilient. Meanwhile, ordinary citizens across multiple countries are already behaving differently, even if they cannot fully explain why. In Argentina, families rush into hard assets whenever inflation accelerates. In Turkey, citizens convert savings into gold and foreign currencies. In parts of Africa and Asia, people increasingly distrust local currencies altogether. Across the world, populations experiencing monetary instability instinctively move toward anything perceived as more durable than paper money, because deep down, humans understand something governments cannot permanently suppress. Currency is only valuable while trust survives, and trust behaves like glass, strong for years, fragile in seconds. That is why the current moment feels historically strange. On the surface, globalization still appears intact. Markets still function. Trade still moves. Financial systems still operate. But beneath the surface, tectonic pressures are building quietly inside the architecture of the global order. Nations are hedging. Institutions are repositioning. Alliances are evolving, not because collapse is guaranteed, but because uncertainty itself is rising, and uncertainty changes behavior long before headlines acknowledge it. This is where the story becomes psychologically uncomfortable for countries closest to the center of the existing system. Historically, populations benefiting most from dominant monetary regimes often struggle to imagine alternatives. The Roman elite could not imagine Rome fading. British financiers could not imagine London surrendering financial supremacy. Stability blinded them precisely when adaptation became most necessary. That may be the deepest irony of monetary transitions. The people closest to the old system often suffer the greatest shock, because they cannot emotionally process the rules changing beneath them. And if the global financial order truly begins fragmenting in the decades ahead, the transition may not resemble a sudden collapse at all. It may feel slower, stranger, more psychologicala, world where trust weakens gradually, where currencies compete differently, where global power decentralizes piece by piece, where the system still functions, but no longer with the same unquestioned confidence, because every historical empire eventually discovers the same truth. The moment a system feels eternal, it is usually entering its most fragile phase.